Hello and welcome to the Genuine Learning Blog. My name is Melissa Galasso and I'm very excited to be here today to talk about a new proposal from the FASB. This is a little bit of a targeted proposal, but it does make sense given the requests that they were receiving from numerous stakeholders. And so this is around investment in tax credit structures. So a little bit of background here. This is going to be updating an existing ASU 2014-01. And so this is titled Accounting for Investments in Tax Structures Using the Proportional Amortization Method, a Consensus of the Emerging Issues Task Force. So this was issued on August of 22nd of 2022, and comments are due October 6th. So again, when they're typically smaller like this, they don't have very long comment periods. They're just looking for feedback. So if this is something that really interests you, this is probably something you want to take a look at. So let's go all the way back to 2014. It's been a while. And in 2014, the FASB issued ASU 2014-01, which was accounting for investments in qualified affordable housing project. And this introduced the option to use what we call the proportional amortization method to account for investments primarily made for the purposes of receiving income tax credit and other income tax benefits. So again, when we think about this, why are they doing this? Because the proportional amortization method results in the cost of the investment being amortized in proportion to the income tax benefits received, right? So then as a result, you're starting to get that nice matching. And so when we look at this, the gains and losses, as we look at this related to the income tax benefit would be then running through obviously that income tax expense. And so investments in other tax credits that are typically not going to meet the requirements of ASU 2014-01 are accounted for either under the cost or the potentially equity method of accounting, and that results in investment gains and losses being presented gross on the income statement in their respective line items. So you don't get to, offset that income tax expense or benefit, and you're not getting the same timing. Now, ASU 2014-01, importantly, was limited to using this method, the proportional amortization method, to low-income housing tax credit structures. So it was very targeted in terms of the relief. And the question that came in, stakeholders have said that typically what they would consider to be economically similar investments, again, primarily for the purpose of receiving income tax credits, are getting very different treatment, because if they aren't in that specific area, then they don't qualify for the proportional amortization method. And so as a result, they believe that those, what we call LIHTC structures, the accounting for them should be pretty consistent. And so as a result, they think it's going to give a better understanding of the impact, right? The returns on the investment, because again, it's not using the cost method or the equity method of accounting. And so because of the limitations, people came back and asked the board to extend the current opportunity for the proportional amortization method to other tax equity investments that generate income tax credits through other programs. And that's exactly what happens here. It permits entities to elect to account for those tax equity investments regardless of the program from which the credits are received, using it if they meet certain conditions. And so all of the following must be met. First, it is probable that the income tax credits applicable to the investor will be available. The investor does not have the ability to exercise significant influence over the operating and financial policies of the underlying project. Substantially all of the projected benefits are from income tax credits and other income tax benefits. And the definition of a projected benefit include tax credits, other income tax benefits, and other non-income tax benefits. And that's determined using a discounted basis and a discount rate that is consistent with the cash flow assumptions related to the decision to invest in this project. And then the investor's projected yield based only on the cash flows from the income tax credits and other tax benefits is positive. And finally, the investor is a limited liability investor in the limited liability entity for both legal and tax purposes, and the investor's liability is limited to its capital investment. And so again, now, as long as you meet these conditions, so again, you're going to be allocable, you're going to not exercise that significant influence, you're going to get substantially all of them are from that income tax credit, right? You're going to be able to use the proportional amortization method. And in that scenario, you amortize the initial cost of the investment in proportion to the income tax credits and other income tax benefits received, and you recognize the net amortization and income tax credits in and other income tax benefits in the income statement as a component of income tax benefit. So again, you don't show it grossed up the way you would if you were going to have a gain or loss from, say, the equity method, or a gain or loss from, say, the cost method. All right. Now, how can we make this? It is an election, and it is on a tax credit by tax credit program basis. So they didn't decide to do it at the reporting entity level or an individual investment level. It is by program, and you would account for the receipt of the investment tax credits using the flow through method under 740, because again, this is running through income taxes. So even if you apply the deferred method for other tax credits received, in this scenario, it's going to be a consistent treatment. Because of this, we do have some disclosure requirements. If the tax equity investments in the project generate income tax credits and other income tax benefits, obviously you have elected to do this, you would actually have to indicate that as a disclosure. And then the impact of the tax equity investment and related income tax credits on the financial position and the financial operations. So again, this is going to be in the annual and interim periods that enables them to get that benefit in the financial statements. So 2 new disclosures as well. All right, so as I said, unless you are in this area and you're investing in these types of structures, obviously not a ton of relevance, but if you are, obviously huge impact here, because again, you'll get more consistent treatment, and it's the more preferred treatment based on stakeholder feedback. So if this is of interest to you, definitely let the FASB know. I'm sure they'd love to hear from you. Otherwise, that's a wrap on today's blog. Hopefully you have a wonderful week, and we will see you in the near future. Have a great day, guys. Bye-bye.